greetings, salutations, salute, however you say it in your neck of the woods. I'd like to welcome you to the very first episode of The Art of Reading Price Action. Again, I'd like to welcome you to the very first episode of The Art of Reading Price Action. My name is Timothy Lee Rogers Sr., aka Aranya Grande, aka Big Spider. You hear me? And I like to say, welcome. And in this episode of Learning to Read Price Action, we will be covering just common terms. Anytime that you embark on a journey, the first thing you want to do is eliminate the language barrier. So, in this first episode, it may be very elementary to some, but it's totally necessary to eliminate the language barrier so that you will be able to follow along with me throughout this whole mentorship journey. This is not an all-inclusive list of terms you need to know to be able to read price action, but these are the most common terms that you need to be familiar with to follow along with me as I teach the concepts that I trade, which are the ICT concepts taught by Michael J. Huddleston. I didn't make this stuff up. I'm just a dude from Fort Lauderdale, Florida that learned something that changed my life, and I'm trying to help people change theirs. Yeah, man. Now, let's get right into it, man. The art of reading price action. The first thing we're going to talk about is simple, a candle. What is a candle? Read it with me, shall you? Candlestick charts display the open, high, low, and closing price for a specific period. You always want to remember, the candles that you're seeing on charts, they are just showing you the open, high, low, and close for a specific period of time. What time period is that? That depends on what time frame that you choose on your chart. If you pick a daily chart, each candle represents a day. If you pick a 1 minute chart, each candle represents 1 minute. Those candles tell you the open, high, low, and close of that particular span of time. All right? An up-close candle. Now, I try to stay away from saying green candles, red candles, because you can change the color of the candles. Everybody chart ain't gonna have green candles and red candles, but everybody chart gonna have an up-close candle and a down-close candle. An up-close candle, the candle price closed higher than it opened, right? A down-closed candle, the candle price closed lower than it's open, meaning on the up close, it opened here and it closed there. On a down close, it opened here and it closed there, right? Pretty simple. The candle body, that's the actual colored in portion of the candle. The rectangular shape itself, that's the candle body. The candle body displays the difference between the open and the close. It's visually showing you it opened here and it closed down here, or it opened here and it closed up there. It's visually showing you the difference in price between the opening price and the closing price of that candle for that specific time period. Wicks. What are wicks? You got top wicks and bottom wicks. Some people call them wicks and tails. Some people call them wicks and shadows. I just say wicks. The top wick, it shows you the highest price. I know that says high, but it shows you the highest price reached during a specific period. The bottom wick shows you the lowest price reached during a specific period, right? Self-explanatory. Also, if you ever see a word in italics on the slides, and speaking of the slides, there is a link in the description where you can download the slides. It'll be the same folder for the entire series. You can download all the slides for absolutely free. If you ever see a word in italics next to a term, that may be what you might hear me call it throughout the series. That may be what you might see me type out or have in text form. Those are just my little terms. They mean nothing outside of the world of little Timmy Rogers, right? The draw, aka Picasso. Draw is the liquidity that the price is moving toward. That's where price trying to get to. That's the draw. It's drawing price towards it. Bias. Bias is the direction price is expected to deliver to. You're expecting price to deliver to in this direction. The bias can be opposite of the draw. The bias can be in the same direction of the draw. Right? So your bias is the direction you expect price to deliver to. The draw is the place where you expect price to end up. You want it to end up at this place. You want to be at Picasso's house, sipping on tea with him. You hear me? All right, bullish. Bullish is speculation that price will go up. Bearish is speculation that price will go down. Y'all follow me? Y'all, these simple terms. You follow me? I hate to say these simple terms because if you're a beginner, this may be all new to you and you may be learning a whole lot right now. So I jalapize. But are you following me? Let's continue on. Buy stops. BSL stands for buy side liquidity. You will often hear me say buy side liquidity. You will often see BSL. You will every now and then hear me say buy stops. All right, buy stops. Buy stops is an order that automatically triggered when price hits it. Right? It's a market order that's automatically triggered when price hits it. Right? Buy stops are set above highs. So they're going to be above swing highs. Buy stops are used to exit shorts. If somebody's already in a short position, they use buy stops to get them out of shorts if the trade is going against them, or they can also be used to enter longs. So if you're not in a trade, if a person's not in a trade, they can use buy stops to get put into a trade on what they call a breakout, right? I don't have breakout on here because I'm not a breakout trader. And we can talk about it later in the series if you want to. Sell stops, aka sell side liquidity. That's what SSL stands for, not the SSL mixing console. That's SSL, sell side liquidity. All right. Sell stops, just like buy stops, is an order that's automatically triggered when price hit it. It's a market order that says, hey, if this position I'm in goes against me too far to the downside, get me out. And where are they set? They are set below lows. They sit below swing lows. And just like buy stops, they can be used to get you into a trade if you're not in a trade already and you want to go short on a breakout to the downside, right? That's buy stops and sell stops. Breaking market structure. Some people call it a market structure shift. I call it a breaking market structure. BMS. You'll see BMS typed out a lot because breaking market structure is a whole lot of words to type, right? Breaking market structure. Price trades through a swing low or high, because you can have a breaking market, you can have a bullish and a bearish breaking market structure, in a price leg that has taken opposing liquidity. Meaning if you go up and take out buy stops and then it comes back down and takes out the low from that same price leg, that's going to give you a bearish breaking market structure. And on the flip side, if you come and take out sell stops and then you reverse back and go and take out the high where the buy stops are now sitting in that price leg, that gives you a bullish breaking market structure, right? Breaking market structure. Equilibrium, right? Equilibrium is the price that's halfway between the highest high and the lowest low in a dealing range, right? A dealing range is just a price leg, a swing. I don't think I put dealing range on here. I probably should have, because that's an important one, but we'll talk about it enough. You'll understand what it is. Premium market, right? Premium market, in that dealing range that we was talking about, the premium market is all the prices that's above the equilibrium. So you got the highest high, you got the lowest low, and 50% of that range is equilibrium. And all the prices from equilibrium up to the high, that's premium. All the prices from equilibrium down to the low, that's discount. Discount market, premium market, and the entire dealing range. Long, right? If you hear me say going long, taking a long, entering a long, long is to buy with the anticipation of price increasing, right? Meaning you expect price to go up, meaning your bias is bullish, meaning you think the draw is to buy side. You want the price to go up. Long, going long is buying with the anticipation that price will increase. Short, to short is the opposite of going long. And when you short, you sell with the anticipation of price decreasing. Liquidity. Liquidity is money. It's open orders at buy stops, buy side liquidity. It's open orders at sell stops, sell side liquidity. And it's open orders that's inside imbalances. Imbalances like fair value gaps, liquidity voids, you know, inside of wicks. The liquidity, that's where the money resides, right? PD arrays. You might see me type out PDAs a lot. This right here is strictly an ICT thing. All the other stuff we've been talking about thus far, those are very common terms. But now this PD arrays, I think for the most part, everything else that we talk about now may be specifically just ICT common terms. So PD arrays, some people say they are called price delivery arrays. I take the name to be premium and discount arrays. That's what I heard Michael call it, and it makes sense in my mind. Premium and discount arrays. There are arrays that occur in the premium, and in discount, you're selling the premium, you're buying a discount off of these arrays. So that's why it makes sense in my mind. Whatever you want to call it, it's on you, but just remember, I break them down into two categories: imbalances and reference points, right? In the imbalance category, you got the liquidity voids, the fair value gaps, and wicks. Wicks aren't a actual PD array that he teaches, but wicks acts as a type of imbalance. So that's why I got it under the imbalances with the PD arrays. The reference points of the PD arrays, you got the mitigation blocks, you got the order blocks, you got the breakers. There's another PD array that I don't talk about much. It's called the rejection block, but we will touch on it every now and then in price action while we're going through the mentorship, but I don't talk about it a lot. These just the common terms. Kill zone. The kill zone is a specific time during trading sessions when ICT concepts are most probable. There are kill zones. We'll cover the kill zone times later, but just remember, it's a specific time during trading sessions like the London, the New York morning, New York afternoon. During trading sessions, it's a specific time where the concepts are most probable, meaning this is the time where they should work out. When the concept should work out. A macro. A macro is a set of program instructions that run at a specific time during the kill zones. So it's a specific time during the kill zone when the macros run, and the macro is a set of instructions that tell the algorithm to do a certain thing, and it run at specific times during the kill zones. Right, so you got the kill zones, specific time. Then the macros is a specific time inside of the kill zones. Yeah, I know it get complicated, but stick with me. Stick with me. IPDA, I-P-D-A, IPDA. IPDA is an acronym for Intrabank Price Delivery Algorithm. Intrabank Price Delivery Algorithm. IPDA is the algo. That's the algorithm name, IPDA. That's what we're going to settle on. Fractal, right? This is not an ICT term. This is a real word. Fractal. Fractals are reoccurring patterns that is repeated on all time frames, right? I think fractal is like a geometrical thing. Yeah, I think I said that right. right? But fractals, meaning stuff repeats on on a larger time frame or a larger scale than medium, then small, then tiny, but the pattern is repeating, right? The pattern is repeating. And price is fractal. What happens on the higher time frames happens on the lower. What happens on the lower happens on the higher. Price is fractal. Consolidation, right? Yeah, all of these are regular terms. Just a few of them have been ICT specific. Consolidation. Consolidation is when price trades inside a clear trading range and shows no willingness to move higher or lower, right? Expansion. Expansion is when price moves quickly from a level of equilibrium. Remember that term equilibrium? Like price tends to consolidate at equilibrium because that's the fair value of that dealing range. You're not in premium, you're not in discount. So when you're at equilibrium, price tends to consolidate. And when price leaves a state of equilibrium and it leaves most expeditiously, they call that expansion, right? Retracement, when price moves back inside a recent created price range. So if price expands rapidly, when it comes back into that range that it just made, that's called retracement. Reversal, when price moves the opposite direction that current direction has taken. So just say if you're going up and then you turn around and go all the way past the low and start going down, that's a reversal. So a reversal will start out looking like retracement, but you know it's a reversal when you trade all the way past the other end of the dealing range and keep going. Now you know, hey, this is a reversal. Displacement, when expansion is coupled with imbalances. So when you expand so fast, you get a piow. I should have put that on the slide right there because that's my little nickname for displacement. Piow. Right? Rejection, when price comes to a PD array and quickly moves in the opposite direction. So if you come up to a fair value gap and hit it like a brick wall and turn around and go the other way real fast, that's rejection. You hit a high and shoot off of it, leaving a long wick, that's rejection. If you hit a PD array and take off the other direction really fast, that's rejection. And with that, we come to the end of the first episode of The Art of Reading Price Action. If you'd like to download the slides, again, there will be a link in the description where you can download the slides for absolutely free. If you enjoyed what you saw, please share it with somebody so that they can get exposed to this information for the free 99. And if you would like to join the paid mentorship, which is $24.99 per month, you can click on the join button somewhere around here on the YouTube page and sign up for the paid part of this mentorship. Until the next one, it's your boy, Aranya Grande, aka Big Spider. You feel me? Y'all be safe out here these trade streets, man. Gone.